Welcome back to Talk Tickers, the earnings summarization podcast for the experienced investor. We are cutting through the noise to bring you the signal on the stocks that matter.
And today we are breaking down the Q4 and full year 2025 results for Origin Bancorp, ticker OBK.
And let me tell you, I've been staring at the charts for this one, and if you only looked at the pre-market action versus the closing bell.
Oh, you'd think we were talking about two completely different companies.
Exactly.
It really was a classic tale of, read the headline versus read the fine print. It was a volatile session. We saw the stock open around, $41.50, but it closed the session at $42.57.
That's up over 6.4% from the pre-market lows.
It's a huge swing.
Right, because in the pre-market, things looked a little hairy. It was trading down near $40, so down almost 1.8%. The algorithms clearly saw something they didn't like.
Well, they saw a keyword. But once the humans actually digested the report, the sentiment just flipped completely.
The market voted buy after reading the fine print.
Yep. We're looking at a cautiously bullish story here where genuine profitability just completely trumped a scary-looking headline on revenue.
Okay, so let's get right into those headline numbers then, because I think that's where the confusion started. The EPS earnings per share, that was the star of the show.
It really was. They reported $0.95 diluted. The consensus estimate was sitting at roughly 86 cents.
So that's a significant beat.
It is. We're talking nearly an 11% beat on the bottom line. And in this environment, with regionals still fighting for every basis point of margin, delivering that kind of surprise is substantial.
It tells you the engine is running better than Wall Street thought. But then we have the confusion, the revenue miss. This is what tanked the stock pre-market.
Right.
The headline showed adjusted total revenue of $94 million, which missed the consensus of just over $100 million. I mean, that looks like a disaster on paper.
A 6% revenue miss usually gets you taken out to the woodshed.
For sure.
It looks bad if you stop reading there. But this is exactly why we do this deep dive. If you actually look at the GAAP components, you take net interest income of $86.7 million, add the non-interest income of $16.7 million.
Okay.
Total revenue was actually $103.4 million.
So wait a minute. The consensus was $100 million. The actual GAAP revenue was over $103 million. But the adjusted metric came in at $94 million.
Precisely. The miss was purely definitional. It was just a mismatch between how analysts were modeling it versus the GAAP reality. The fundamental cash coming into the bank was actually higher than the street expected.
So once investors realized that, the panic selling stopped and the buying started.
That's the story.
Okay, top line is healthy. But let's talk about efficiency, because that seems to be the real story here. Net income was $29.5 million, but the number that really jumps out is the ROA, return on average assets.
It's the ultimate scorecard for management's execution. They hit 1.19%.
1.19. And for context, their big internal project, Optimize Origin, had a goal of just getting back to a 1% run rate by the end of 2025.
So they didn't just hit the target.
They smashed it. 1.19% is well clear of 1%.
And that matters because it proves leverage. It proves they can squeeze more profit out of the same asset base. For a bank this size, around $10 billion in assets, an ROAA near 1.2% puts you in a very elite tier.
We also saw the net interest margin, the NIM, expand by 8 basis points to 3.73%.
In a world where funding costs are still high and everyone is complaining about deposit costs, expanding margin is like
the holy grail.
It's the holy grail. It is so rare right now. Most banks are seeing compression.
And they're returning that capital to shareholders. Dividend raised to Zyros in 16 cents a share, and they repurchased roughly 49,000 shares in Q4.
Which brings the total for 2025 to about $16 million in common stock repurchases. It's a signal of confidence. They're not hoarding cash.
So beat on earnings, a fake miss on revenue, strong profitability. But the real story here, the thing that I think is going to drive the stock in 2026 is the strategy shift. They're moving from defense to offense.
This is the pivot point. If you look at 2025, the whole year was defined by that Optimize Origin project.
Right, the housekeeping.
Exactly. Expense discipline, balance sheet management, removing friction. It was all internal.
And it was pretty aggressive housekeeping. They reduced full-time equivalents FTEs by nearly 7% in 2025. But here's the stat that blew my mind. They cut their commercial banking teams by almost 25% over the life of the project.
That sounds counterintuitive for a growth bank, doesn't it? Firing a quarter of your bankers.
It sounds like shrinking. If you're a commercial bank, your product is selling loans. If you fire 25% of your sales force, aren't you just exiting the market?
It looks that way from the outside, but it's actually pruning. They were weeding out underperformance. They looked at the data and realized a big chunk of their bankers were managing portfolios that either weren't profitable enough or were just too risky.
So less layoffs and more addition by subtraction.
Exactly. And the proof is in the data. The average ROA of the remaining bankers' portfolios increased by 26 basis points. They got smaller in headcount, but much more profitable in output. The bankers left standing are the A team.
Quality over quantity. But now that the pruning is done, the tone for 2026 feels completely different. Management started using some very strong language. They called the current market a generational opportunity.
That is a loaded phrase. Usually when a CEO says that, you hold on to your wallet because they're about to go buy a competitor at a 40% premium.
Exactly. But Origin is explicitly saying that is not what they are doing.
No, they're looking at the M&A disruption in their market, specifically Texas and Louisiana. Competitors are merging. Big regionals are swallowing up smaller ones.
And we all know what happens during a bank merger.
Chaos.
Absolute chaos. Systems change, credit boxes tighten, and most importantly, the top-tier bankers, the rainmakers, get unhappy.
Their comp plans change, their titles change, or they just hate the new culture. This creates disruption.
And Origin is standing there with a net ready to catch them.
More like a war chest. They explicitly said they're deploying about $10 million specifically to hire banking talent that is being displaced by competitors.
10 million, is that a lot for a bank this size?
It's significant. It's a direct investment in operating expense. They're choosing to increase their salary line because they see an arbitrage opportunity. They've already added, 10 plus production bankers in Houston and Dallas-Fort Worth.
This is the core bullish thesis for 2026 then. It's not about buying other banks. M&A is messy.
So messy, you inherit bad loans, bad tech, skeletons in the closet. This strategy is about lifting out entire teams of bankers.
Right. You get the revenue generators and their client relationships, but you don't have to buy the legacy headache of the bank they worked for.
It is organic growth on steroids. You let the other guys deal with the integration fatigue, and you just take their best assets, the people.
It's smart, but you've got to have the data to know who to hire, right? You can't just hire anyone with a Rolodex.
That's a key point. The CFO has built a very data-driven culture. They're using data to fire unprofitable clients and to hire profitable bankers. This isn't a gut-feeling hiring spree. It's Moneyball for banking.
We saw that discipline in the portfolio stats, too. Origination volume hit a 2-year high, while payoffs dropped to a 2-year low.
That is the golden ratio for a lender. You want the faucet open for new business and the drain plug so your good loans stay on the books.
Okay, let's talk about the financials and guidance a bit deeper, specifically that net interest margin. We mentioned it hit 3.73% in Q4. What's the outlook there?
So management was transparent here. They expect slight compression in Q1. This is technical. It's due to repricing lags.
Okay.
When rates shift, their deposit costs reprice pretty much immediately. But the loans, they take about 30 days to adjust.
So you have a 1-month mismatch.
Exactly. It's temporary. They are targeting a return to the 3.76 to 3.0 over an 80% range by Q4 2026.
And what are they assuming the Fed is going to do?
They're being fairly conservative. Their model assumes 25 basis point cuts in March and June. So they aren't betting on some massive pivot, just a steady easing.
One thing I found fascinating was the geographic dynamic. Everyone talks about Texas as the growth engine, but it seems like Louisiana is doing the heavy lifting in the background.
It's the Louisiana advantage.
Yeah.
While Texas provides the high-yield lending growth, the rural Louisiana footprint provided 14% deposit growth.
14% deposit growth in rural markets. That seems incredibly high.
It is, and here's the crucial detail. This is at the lowest price point in their portfolio. These are sticky, relationship-based deposits. They've banked with Origin for 30 years.
So that is the arbitrage. You take cheap deposits from rural Louisiana and lend them out in the booming Texas markets at a higher spread.
It's the classic banking playbook, but they're executing it really well. That cheap funding is the fuel for the Texas fire.
Now, you can't talk about aggressive lending without talking about credit quality. Any cracks in the foundation?
It looks stable. Non-performing loans, NPLs, dropped to 1.06% of total loans. The provision was a very manageable $3.2 million.
I did see that classified loans ticked up slightly. That's usually the canary in the coal mine. Should we be worried?
It's worth watching, but management framed this as intentional. They are aggressively moving out weaker credits. In fact, 75% of the client exits they processed, the firing of clients we talked about, were criticized loans.
So they're actively showing the door to risky borrowers before they default.
Exactly. Goes back to that data-driven culture. The allowance for credit losses, the ACL, is stable at 1.26%, so they have a decent buffer.
Let's look at the expense side. We know they're spending that $10 million on hiring. Is that going to blow up the expense line?
That is the risk. However, they're guiding for mid to high single-digit loan and deposit growth for 2026, and they claim they can offset the hiring costs with other efficiencies.
Like renegotiating tech contracts.
Yes, and continuing that rigorous control elsewhere, they are aiming for an ROA run rate of greater than or equal to 1.15% by the end of the year. If they can hold that while absorbing $10 million in new salaries, that is impressive.
It means they're cutting fat to pay for muscle.
Well said.
So, putting this into context for our listener, why should they care about Origin specifically? There are 100 regional banks out there.
It's a sector play with a specific edge. Regional banks are leveraged to rate pressure and deposit flight. We all remember the spring of 2023.
Right, the hot money problem.
Exactly. But Origin has zero brokered deposits right now.
Zero.
They replace them all with core deposits. That means their funding is stable. They aren't relying on hot money that will vanish the moment there's a scare.
That is a massive safety blanket.
And look at the relative performance. OBK is up about 14.8% over the last year. Compare that to the regional banking ETF, KRE. It's up only 7.0%.
So they're doubling the sector performance.
They're generating alpha. The market punished the headline but rewarded the core profitability. It suggests investors want clean balance sheets and efficiency over raw, messy growth.
The catalyst to watch seems pretty clear then. It's the success of the new hires.
Can they convert that $10 million investment into loan growth in the second half of 2026? That is the gamble. If they bring their books of business with them, OBK could surprise to the upside again.
It's a show-me story on growth, but a trust-me story on profitability.
And so far, they've earned the trust, they've cleaned the house, now they're ready to host the party.
All right, let's transition to everyone's favorite segment. Please remember, what we are about to say is for entertainment and educational purposes only.
Absolutely. Do your own diligence. We are just two voices on a deep dive.
It is time for the This Is Not Financial Advice segment. We are going to pitch a trade idea that is wild, plausible, and based entirely on the data we just discussed.
I call this one the human capital arbitrage pairs trade.
Ooh, that sounds fancy. Break it down for me.
The thesis is simple. Banking is a people business. Origin is aggressively poaching top-tier talent from large regional competitors in Texas who are distracted by messy M&A integrations.
Okay, so we have a winner and a loser in the talent war.
Precisely. So the trade is this. You go long OBK. You're betting on the efficient acquirer of talent, but you hedge it. You go short the specific large-cap regionals operating in Texas that are currently announcing mergers.
You're betting on the brain drain.
You're betting on brain drain and integration fatigue. Think about it. You're hedging the sector. Risk the banking beta. If the whole sector crashes, your short covers your long.
So you're neutrally positioned on banking itself.
Correct. But you are isolating the alpha of the talent migration. If Origin spends that $10 million and successfully steals the best rainmakers, their loan book grows with high-quality assets.
And at the same time, the donor banks, the ones losing these people, lose their best revenue generators right when they need them most.
It's a bet on the bankers, not the banks. If you believe, as Origin does, that this is a relationship business, then you buy the place the relationship managers are going, and you sell the place they're leaving.
That is ruthless, and I love it. Again, not financial advice, just a scenario for the brave.
For the brave, indeed.
So let's wrap this up. Origin Bancorp Q4 2025. They beat on EPS, the optimized Origin plan worked and cut costs, and now they're pivoting.
Pivoting to offense. They have the war chest, they have the profitability baseline, and they're going hunting for market share in 2026.
It's going to be a fascinating year to watch the Texas banking wars. We'll be watching that loan growth number in Q3 very closely. Thanks for listening to Talk Tickers. Do your own diligence, check the numbers yourself.
And we'll see you on the next print.